All right, folks, I think I'm getting confirmation that we can see and hear, so we're going to go ahead and move along. This is a two-part series. So just to give you a little background on this, not a whole deep here. So we started looking at hybrids, long-term care, and looking at the industry. There's been a big paradigm shift to selling these hybrid products versus traditional long-term care. I started doing some internet leads a couple years back, and I started running into so many hybrids. And, I think we all know that 10 years ago, there was 5 traditional long-term care policies written for every 1 hybrid. And now we've went full scale the other way. There's 5 hybrid long-term care plans written for every 1 traditional. And so why is this? I dug a little deeper. I started putting some numbers together, and I came up with kind of a surprising numbers. So that's kind of the genesis of why we started this webinar. I started really breaking down the numbers. In other words, is it better to buy a hybrid if people are worried about fear or use it or lose it? So, and we started out with the gloves concept, saying, I don't understand why people are selling these hybrids. I want to take that kind of down a little bit here. There's a time and place for everything. So it's not like we're competing with hybrids. GoldenCare does do hybrids. We have, One American, some other great carriers that we work with, Security and Life. And so this is more or less just kind of pointing out when the right time to use them, when there isn't. But there's a 2-part to this. As I go through this, the next 20, 25 minutes, I'm pretty sure I'm going to convince you that hybrids are being overused, and that 9 times out of 10, you're better off doing a traditional long-term care plan with coupled with a standalone life insurance policy of some kind, whether it's second to die, individual, universal life. There's just a lot of better ways, if the person's worried about getting their money back, to design things other than hybrids. So the second part to this is, okay, now that I've pointed out that it's clearly a better way to go, how do we get clients to write this? This part kind of came from a couple of good questions from a good agent of mine down in Florida, who kind of pointed out, he said, Jeff, I don't disagree with you that I think breaking these plans up is a better way to go. But how do you get your client to sit through, having sold traditional long-term care, then being sold a hybrid, being showed which one is better, and then telling them a third option is going to be life. So we're going to try to address that, try to take some steps down. So we're trying to make that transition so your clients can see where that is, and that's kind of towards the end. So let me get rolling on this. We were actually going to add another slide right here. I'm going to get my soapbox for a second and try to speak to every long-term care agent that's on this call. Whether you used to be a long-term care agent or you're currently a long-term care agent, you used to sell some, maybe you only sell 1 or 2 a year, whatever it is. I wrote this slide a year ago, a year and a half. The demand for long-term care has never been higher. I used to tell you there's no one universal way to solve a long-term care situation. Whether it's traditional long-term care or hybrid or annuity, or there are a lot of tools out there to satisfy this. No one tool is the catch-all universal way to every time solve something. So I just want to, again, this is not necessarily a anti-hybrid thing. It's just that there's more ways. But on this slide, take a look at this demand for long-term care. I'm going to pause, and I really meant to get kind of a slide added to this. But with COVID going on right now, when I say there's never been a higher demand for long-term care agents, that 61% of people now would rather die than go to a nursing home. 3/4 of all deaths in Canada from COVID are in nursing homes. If you look at the United States, it's above 50. Well, some stats will tell you 40%, some will say 50%. Some states like Vermont, 71% of deaths were, New Hampshire, 71% of deaths were in nursing homes. Now, we have a situation in America where our stats aren't always right. We kind of bend the rules, bend the stats, try to, say one thing or the other. So we've got an underestimated, undervalued amount of deaths that are happening in nursing homes. The stats tell me 40%, 50%. I think it's higher than that personally. But the point I'm making here is that people are afraid right now. There is a humongous amount of fear and anxiety about going to a nursing home, about going to a facility, about having some choices. 81% of people, this is according to a survey, I'll get the name of that survey. We'll send it out as part of our kind of a relay on this, but 81% of people now look at long-term care as an important part of their planning situation. 85% of people are looking at long-term care. The reason I'm saying all this, folks, is that if you're in long-term care, there has never been a better time to sell long-term care. Our clients are scared, and there's a lack of agents out there asking them about long-term care. So if you've got a Medicare book or you've got just a list to mail, we've got pre-approach letters that speak to things about COVID and about how we can solve these solutions for them, and that they do have choices that they can maybe avoid going to nursing homes. So if you're not taking advantage of all that, this is, again, a great time to be selling long-term care. But let's go back to topic here. Okay. So there are a lot of good reasons to sell hybrid long-term care plans. Like people have, and we get an old life policy annuity sitting there. It's not doing anything anymore. It's available for tax-free exchange. There's no surrender charges anymore. Great. And they're not doing anything with $100,000. Maybe then you buy a single pay, hybrid of some kind. All right. Maybe you got some uninsurable health risks that traditional long-term care won't touch. These are actually a better fit to the annuity-based ones, but we all know that these hybrid long-term care plans are underwritten. And once you've been declined traditional long-term care, it's not like you can go over to a One America or a Security and say, I want to buy this. So they are underwritten. So chances are, if your clients decline for long-term care, they're not going to get many of the hybrids either. Okay. But there is some places in annuities that you can maybe find a niche for them. Maybe you want 100% cash benefit. This is something that Securian does. I think Nationwide is also 100% cash benefit. That's a really nice benefit to have. You'll never hear me argue against having 100% cash benefit. A little hard come claim time in the insurance company, but whatever. That's one I'll give you. Most long-term care companies will max out at 40%, 25%. Some clients, by the way, just refuse to buy traditional long-term care. Their brother-in-law is a smarty financial planner, and he said it's a not good thing to buy. So whatever reason, this guy is dead set about ever buying traditional long-term. Well, I'm not going to argue with a guy that's absolutely not going to listen to me. Even if I can show him better, he's not going to listen. Well, then I'm going to sell him a hybrid if that's what he wants to buy. All right. So these are all rare situations that come up. All right. So sometimes people want a guaranteed premium or paid up premium. By the way, that is available with traditional long-term care now. NGL just went guaranteed premiums on their 10 pay. So you can still get the guaranteed premiums. A lot of financial planners will also say that, you had lifetime rate guarantees on the rates, et cetera, and I'll address that. So these are all small reasons why people sell hybrids. Okay. And they're all justifiable reasons. This fits to about 10% of long-term care sales. Then why is it that 90% of people are selling hybrids, even when they don't fit? All right. The biggest reason is this fear of use it or lose it. I'm going to show you here in the next 15, 20 minutes that we can address that in a lot less expensive manner and get them all their benefits back, all their premiums back, and still get them a quality long-term care plan. So 3 things I want to consider before I go into my comparisons. The 3 key abilities to consider with traditional long-term care: rate stability, plan design and flexibility, and premium tax deductibility. Okay, the abilities. So let me just cover these real quick. Rate stability. I've done this one a couple of times. No matter what you're going to hear, most of the financial planners say, what you're going to hear people say is, look, the rates on long-term care are not guaranteed. So you might be able to be lower in price if you break up the long-term care in life, but what if you have a rate increase? And I do hear that, and that's legitimate concerns. Let me just talk about that. Fact: modern long-term care policies are much more price stable than any prior product generations. You know why? Well, because we have claims data to go on, right? Society of Actuaries, the pricing shows the underlying actual pricing assumption has been de-risked. Lapse rates are now set at less than 1%. They were set at 8%. Investment returns, that you were set at basically too high. Now we're using ultra conservative low investment returns, so they're set at the lowest rate ever. Claims, again, we have a ton more claim data. 16 times more policy data, 70 times more claims data compared to 15 more years ago. So 70 times more data to look at. They can get a little more accurate. Regulatory, you've got states and other things, penalties, margins for accuracy. So if you look at all this together, long-term care rates, this is today's policies. I'm not talking about the ones written 15 years ago. And this is a study from, again, the Society of Actuaries saying that, this is a 2014. I think there's a 2017 out that lowers this to even 5%. That long-term care, the chance of them having a rate increase, less than 10%. And again, these are on the new policies that are sold. I'll give you the fact that one's written 2000 earlier. So there's still this leftover, this hangover, if you will, that long-term care premiums are going to go up. I've got an article. It's from Too Legit to Quit out of Brokers Magazine. I've got another great article that Jesse Sloan is quoted in. It's saying how stable the rates are. So this is a concern here as your clients. I'll get you a couple articles that will speak to this. The point I'm making is that today's policies are very stable, and we don't expect to see them have the rate increases that they had before. But even if they did, we got room for that. So I'll come back to that. So don't let the price stability of long-term care scare you anymore. These things are very stable. Okay. Here's the other thing, and this is, I don't harp on this enough. I really should. The unparalleled flexibility of plan design. You know, people are coming to us to solve the long-term care need, right? They're concerned about the long-term care. You know, the parent going to a nursing home, just like I mentioned with COVID, and ending up in a facility, or, well, the reason you sell long-term care is because I can be flexible. I'm using a pure traditional long-term care plan, and no one's going to argue this. The benefits you get out of a traditional long-term care plan are going to be better than something you get out of a hybrid. A hybrid's kind of like one size fits all. Whatever you buy in life insurance, they're giving you this long-term care benefit. Part of this premium is going towards, these are very vanilla benefits. Matter of fact, I use this example, you know, long, skinny versus short and fat. Matter of fact, my next slide down, because in some of the examples in this, Mutual had some rate adjustments, so I had to kind of tweak my rates a little bit. In other words, I go with higher daily amounts. Look at this example. $270,000 pot of money on all three of these examples. Okay, I'm selling $270,000 pot of money for long-term care. One of them, I'm going to do a 5-year benefit, right? I'm going to spread it over a long period of time, $150 a day, $45. Another one, I'm going to do a 3-year benefit. Another, I'm going to do a 2-year benefit. And by the way, I'm going to lower the inflation because I'm starting out at $10,000 a month or $7,500 a month or $40. So look at how much lower the premium when I use a higher monthly amount, higher daily amount, if you will, and a higher overall. The maximum is not going to change. I'm just going to kind of move around the. So I can change premiums and I can look at future values of what it pays out. So over here, long for $11,048, I can have something that pays me a benefit of $11,900 20 years. For half that premium, I can have something that pays me $12,200 in 20 years also. So as I do these, I'm going to be kind of using, this is my point about the unparalleled flexibility. You can't do this with your plan. So when you're selling a hybrid, you're getting a long, skinny benefit, $4,500 a month. We know that's not going to cover anything. It's going to cover half the benefit. So, you know, if I want to use lower inflation, higher amounts, I don't get that ability. So I'm going to design a lot better product to satisfy the long-term care need by going with traditional long-term care and coupling it with a standalone life. So again, there is price stability, there is unparalleled flexibility, much, much better policy design. And the tax deductibility, here's a tough one. Now, you can always deduct the long-term care portion off of a hybrid plan. So looking at the amounts, I ran some rates for a 65 to 70-year-old, and the rate was like $7,000 for husband and wife that were 65 and I think 65 and 60. So I looked at deductions for this, and the life portion is, you know, like a bulk of this $6,700 premium. The long-term care portion is only about $2,500, so they can only deduct up to about half of what they could be if they buy a traditional long-term care. So the point I'm making, this it's not much less, but the tax deductibility of long-term care is a lot better. You know, there's better straight line deductions for state ones. So overall, generally speaking, traditional long-term care has better tax deductibility to it. Okay, so let's go into comparisons. And for the first couple of these, well, I'm going to show you actually the NGL. Okay, so this is actually, let me escape so I show you what I'm doing here. All right. So what I've done here is this is Pacific Life's 10, they do it as a 10-pay, they're hybrid. Okay, so what I'm going to do is I'm going to put together a long-term care benefit of $330,000. I'm going to do a $5,000 a month benefit. It's like a 5-year plan, right? Okay, I'm going to put 3% compound in there. And this is how Pacific Life does theirs. So if you use up your whole $330,000 life long-term care benefit when you don't get your death benefit, okay, but they have a death benefit of $120,000. So you get either $330,000 at $5K a month for a long-term care benefit, or if you die in your sleep, they're going to give you a $120,000 death benefit. All right. So the combined annual 10-pay premium on this for Pacific Life, $44,088. All right. Gotta tell you, folks, I look at this. I leave with this example just because I really want to get your attention. So I ran a 10 pay with National Guardian Life. They have a 10 pay. It's a guaranteed premium. The premium that is $12,760 for the 65 and 70-year-old couple. So with that, remember the whole fear of use it or lose it? Well, if it's a 10 pay at $12,000, then really I'm looking to get $120,000 back. I want to duplicate this $120,000 death benefit they get in case they die in their sleep. So what if I were to do for a 65 and 60-year-old couple, if I were to do a second to die, that's going to return them $120,000 death benefit. Well, I actually have that right here. This is just got this. So this is a quote from Columbus Life I'm using here. And you guys may have different, I know there's some people on this webinar that are from different accounts we have. We don't necessarily support the life side of what you do through us, but I'm sure you have life products or access to them. If you don't, GoldenCare has access to a lot of these companies that will help you do this. We're using Prudential and Columbus Life and F&G for some of the fits here, but okay. So the reason I'm using Columbus Life is they actually have a second to die that goes as low as 120 for illustration, so that's why I use them. Good company. This was actually prepared, let's see, this was March 23rd today. All right. So yeah, March 23rd, 21. So you take a look at what a second to die costs for a 60 and 65-year-old standalone. This is a single index universal life. It's a second to die, right? So death benefit option. So the premium of this is $31.27. So going back to my presentation, that's where I get this $31.27. The premium for the 10 pay long-term care with a benefit of $330,000. Actually, what I did with NGL is $310,000 and a $5,100 a month benefit, which is as close as I could get. It's as close as I could get to doing a $330,000 benefit with a 5K. So I'll show you that a little bit later in the presentation. So that premium, $12,600 added to the $3,000. Look at this total. $15,000 as opposed to $44,000. Now, an agent, and by the way, this is a 10 pay. I had two things this slide. I had an agent tell me originally, he said, well, you're using a lifetime pay on this life portion. And you're right, that total was $2,000. So I've corrected this. This is actually, on this quote I just showed you, this is a 10 pay, second to die life policy that has a death benefit of $120,000. So this is for a husband and wife, 65, 60. So take a look at this. If I were to sell this $3,100 and then couple it with a $12,760, I have matched both benefits that Pacific Life is putting out. Difference is my premium is $15,887 for 10 years, as opposed to $44,000. Holy goodness! I mean, it shocks me how much hybrids are being sold. It just shocks me. Every time I do this, I'm dumbfounded. So then, to be fair, in Pacific Life, they're each going to get a death benefit of $120,000 if they both die in their sleep, which it doesn't happen that often in married couples, but let's just say it does. Okay. Well, in that case, I actually had to run individual indexed universal lives. So for the male, got a little pricey. At a 10 pay, was $55.15. For a female, it was $38.40. So if I add all those up, I get $22,000. You'll notice I'm still half the premium, right? And let me just show you just for these again. I got these quotes today. So this is, again, no, this is before. That's a single pay. Yep. So these should be, March 23rd. This is for a 65-year-old male, $55.15, 10 pay, $120,000 death benefit. And for the female, same thing here, $38.40. So I go back to my presentation. That's where I'm getting these from. I want to show you these premium just so you guys can kind of, this helps for the second part of how to put this together. But so here's your total now, $22,000. So take a look at what this looks like come claim time. So in other words, for about a third of the premium, okay, $15,887 as opposed to $44,000. Average claims, we're going to say claims happen around 81 is the average. So 20 years later puts these people at 65 and 80. So right there at claim time. So 20 years out, what does it look like? Well, my long-term care with a second to die life is paying $9,200 a month. The Pacific Life is paying $9,000 a month. My long-term care benefit, the Pacific Life's got a little bigger overall benefit, but again, the monthly here, pretty close, $596 versus $559. By the way, up here, if I use this long-term care benefit, I have an Alzheimer's claim, I use it all up, I don't get my death benefit. It's an either or deal. So down here, for again, 1/3 of the premium, I get both benefits guaranteed. So it's kind of like use it and don't lose it, right? So this is a much better solve than selling someone a hybrid. Down here, by the way, again, for half the premium, because remember, I did 2 death benefits here now. So I get $240,000 coming back, $120,000 times 2 for each one of them. My total on that was $22,000. So now again, I've got a benefit payout $9,559, and I get the $240. Not or, and. So much more powerful. So I'm going to do this. I'm going to pick up the pace on these now, folks. Okay. I want you to get done here by 2:40 here, about 15 minutes or less. So I do the same thing with a variety of carriers here. So this is Securian. This is their 10-pay. They do theirs a little differently. Whatever you pick in your death benefit, the same as your long-term care benefit. So there, it's a $121,000 death benefit. This is a married couple, 65 and 60 again. Okay. So I do a 121K and 5K benefit, 3% compound inflation, 120,000. So again, they get either a death benefit or a long-term care benefit. The premium for that on a 10-pay situation for this married couple, $21,690. All right. No, it's a lot less long-term care benefit. That's why the premium's lower. But let me compare this now to an NGL using a benefit of $121,000 and $5,000 benefit 10-pay plan. With NGL, it's $8,166 on a 10-pay. My life premium for this, remember, I just showed you this one from Columbus Life. I'm going to switch back one more time. I'll go back into presentation mode so it's a little bigger for you to see, guys. But so $3127 plus 81, my total is $11,293. Again, half the premium. So here, remember, to be fair, I want to give them both death benefits. But honestly, to be fair, if they're paying this $8,100 for 10 years, well then, at this $121,000, that's a guaranteed premium. So that's only $81,000 they're ever going to pay in. So I don't really need a second death benefit, do I? If we're worried about use it or lose it, then this $3127, I could drop this down to $80,000. That premium would be about $1,500. So again, for half the premium, I can accomplish what they're worried about, getting their money back. But if they do need two life benefits guaranteed, well, then it's $17,500. Either way, I'm coming in under. And take a look at the benefits again. So I'm going to give them the same payout, the same benefit, except for I'm going to give them both benefits guaranteed. I'm going to give them better tax deductions. I'm going to give them a better long-term care policy because the traditional long-term care policies are basically better than the hybrids. Okay, and I'm going to give them both benefits. And I give them both benefits. They don't have to pick between the two, because if you use one, you don't get the other, vice versa. And the premium's twice as much. Okay, so let's take a look at another one now. Let me look at Nationwide's a lifetime pay. So here, again, this is how Nationwide does theirs. This is actually paid to age 100. This is a long-term care benefit of $185,000 and a monthly benefit of $5,000. We're using 3% compound. This is a married couple between 55 and 50. The death benefit, how Nationwide does theirs, is they pay you a $120,000 death benefit if you die in your sleep and never need long-term care. Okay, so what does that cost for a lifetime? It's $9,356 every year for the rest of your life. All right. So let's do this long-term care-wise. I'm going to do a 55 and a 50-year-old couple. Now, remember I talked about the unparalleled flexibility and things like this? With my long-term care plan, I'm going to try to get these benefits come claim time. If you'll notice, I'm going to try to get these to match out. So to be creative here and to get around some of the price increases and some of the rate adjustments that Mutual made, I went with a higher amount to begin with. I went with a $9,000, so a $3,000 pot of money, $9K, and a 1% inflation. So if I bring up my software, okay, let's make that a little bigger so you can see that. Ooh, don't blink out on me now. Stay with me. All right. Guess it doesn't help that much. I'm hoping you guys can see this. So I have a $300,000 pot of money. I have a 55 and a 50-year-old couple. I got a $9,000 benefit. I cut the assisted living back because half that's $4,500. We were at $5,000. I put 1% inflation on here. My premium is $4,713. Okay, $4,713. Now, by the way, these people are younger. This is a 55 and 50-year-old couple. So a second to die life for these folks. Take a look at this. So this is, do I have the second to die here? Let's just think, this is the individuals. I'll bring these up. So the individual premium for second to die is $1,232. For a if I gave them each their own death benefit, to be fair to Nationwide, remember they get each of them get a death benefit of $120,000 here. So I ran two individual indexed universal annuities. The premiums on those were, so here's the one for there's a female, this is a male, $120,000 death benefit, male 55, okay, lifetime pay, 1556. Female was the same thing, $120,000 death benefit, $942 annually. So let's take a look at how this compares. So for a benefit that equals this long-term care benefit and a death benefit that equals this death benefit, I can pay $59 instead of $93. And if I want to give them double life, which again, I don't know why you're selling them all this life insurance. They called you and asked you about long-term care. And suddenly we're selling a bunch of overpriced life insurance to solve the long-term care need. Doesn't make any sense, but that's what people are doing. Okay. Both these premiums are way under the $9,300. Okay. And come claim time, they're the same benefit, except for the one caveat. Remember, this is an and. This is not an or. Yeah, every time I do this, I scratch my head as to why people are selling hybrids, why so many hybrids are being sold. There's a time and a place for them, but they're being so overused. So here we go. $12,000 $131 benefit. And match this out. Claims again, we're going to say between 85 and 50, between 80 and 85 is when claims happen. So 30 years down the road. Same monthly payout, $405,000 benefit, and $120,000 guaranteed. Or here, $240,000 guaranteed if they both want their death benefit. Either way, much cheaper. So this is the example with Nationwide. To speed things up, I'm not going to show you the 65-year-old example. Same thing here. Here's a 65 and 60. Even gets more expensive to buy a hybrid. If you separate them out, 2010 for second to die or total of this, so 10,000 or 8,000 as opposed to 15,000 for, again, same benefit come claim time, except for you get both benefits. All right. So done Nationwide. Let's take a look at the big one, One America. Got three quick examples, and we'll wrap this up. One America is kind of the cat's meow out there. That's what everyone's writing. Why? Well, it's the cheapest. Let's just be honest. One America does not have a cash benefit of any kind. It's a reimbursement benefit for long-term care. It's also built on a second-to-die chassis. So I don't have to worry about pricing two individual indexed annuities because this is a second-to-die chassis. So it's the less expensive way to do the life. It's a less expensive way to do the long-term care. We all know in long-term care that when we sell a reimbursement benefit, you can't pay your spouse, you can't pay your daughter, you can't pay the neighbor kid who's shoveling the driveway or mowing the lawn. So, a lot of you get claim headaches, right? It's reimbursed. So, but we're trying to save money. The person doesn't like the idea of a long-term care plan. He's going to use it or lose it. So agents have said, what you could do is you could buy a hybrid, right? And so they'll show them One America. So I'm going to show you three examples. I'm going to show you a single male, single female, and then I'll show you the unlimited benefit with One America that so many people kind of hang their hat on with that. Okay, so quickly, if I use a 65-year-old male, single, I'm going to use a $166 death benefit and a $5,000 monthly benefit. Now, they get a death benefit of $166, or they can use the $166 at the tune of $5,000 a month for their long-term care benefit, 33 months. What I did here is I inflated the beginning benefits, not the continuation benefits. So on this one, then I have a rate of $8,098 for a single male. If I take a long-term care plan for, again, a 65-year-old male, I do a $166 death at $5,000 a month with 3% compound. My rate comes in there at $1,805 a year. Okay. If I add that life premium, so this is going to give me a $166 death benefit for a 65-year-old male, $3,891. It is expensive. Okay. So my total here, $1,805. Plus $389, so my total is $5,696. All right. And by the way, this is no inflation. Excuse me. With One America, this is no inflation in the long-term care part. There's no inflation in the long-term care part. So this is non-inflating. 8,000 versus 56. Now I went ahead and I put the inflation in the AOB. This isn't the continuation of benefits. So now I have inflation on this base benefit. So for a 65-year-old male with inflation, without it, 8,000. With it, 10,000. Over here on Mutual Omaha, I did a 166 and 5,000 month benefit. Then I added the life insurance for the male. $38.91 plus $3,023, my total $69.14 as opposed to $10. So again, whether I'm using inflation or not, I'm coming in about 30-40% under the One America. And come claim time, again, I've matched these benefits out. No inflation, no inflation. Well, it's the same thing here. Same payout, same death. Big difference here, though. For a lot less premium, I get both benefits guaranteed. If I use up the 166 in long-term care, I'm not getting my death benefit with One America. And by the way, when I'm using my long-term care benefits, I've got a cash benefit paid in it. I can pay family members. I can do so much more with the claim when I'm on it. So again, I scratch my head. Why would you pay a lot more premium to have a crappy long-term care solution in the same, and have to pick between life and long-term care? You wouldn't. You'd separate them out. You'd sell a separate long-term care and an indexed universal life. All right. And if I put the inflation thing here again, I match the benefits out in 20 years. Claims happen at 85. Okay, so $9,000 a month versus $225. Same exact benefits. The premium is just again about 30% less. Okay, that's for male. That's for a male. Female is going to work out about the same here. Okay, female's got a little bit closer to age 60. It was $4,000 versus $5,700. Again, for the life and premium for the female is only $2,000. The long-term care bumped up to $1,955. Again, at $166, 5%. Without inflation, with inflation, that jumped the premium to $32 for a female, for the 60-year-old female. Same life insurance. I'm getting $166 back in death benefit. So it's $2,113 plus either $32, so that's $53, or with no inflation, $4,000. Both scenarios, about 30% less in premium, right? A lot less premium, and come payout time, same payout, right? The payouts are pretty similar here. The only difference is I'm getting both benefits. I hate to keep harping on this, but it's or versus and. That's huge, right? First of all, I'm already paying a lot less. I'm getting a better long-term care benefit with the cash, the flexibility to pay family members, actually pay for the care that's happening. Okay. I've still got my second to die, or my index UL here was second to die. So I'm getting all my money back, no matter what happens. And for those that talk about the rate increases, let me just hit this real quick. So the long-term care premium, this, well, sure, it's $1,955 or $32. Well, what if they have a rate increase? What if they go up again? Well, they're not supposed to. Like I just showed you that they're pretty stable now. But let's just play devil's advocate. Let's say that premium bumped up 50% again. Well, now I'm at, $4,500. I'm still way under the hybrid. So even if you do have some rate increases, which I don't think you will, or see as anywhere near the ones we did, you're still coming in way under. There's still just so many more advantages to selling and breaking them up. Okay. Last example. This is kind of the crown jewel. All right, because this is what people sell One America for. It's because of the unlimited benefit, right? So what I'm going to do here is I'm going to do the base benefit and the continuation of benefits. Okay. So I'm going to do 3% on this, and I'm going to do, so one's going to have the continuation of benefits, one won't. So without continuation of benefits, just a base plan for a married couple, 55 and 50, if I want to get $166 death benefit, a $5,000 a month benefit for my nursing home, which comes with the death benefit 166. Premium on that is $75.15. 56.58 on the total for life and long-term care. Now, if I go with the continuation of benefits here, the unlimited policy for this couple that's 55 with One America, that's a lifetime premium of $13,890. So what I'm going to do here is I'm going to get to that benefit. I'm actually going to go to my software. I'm going to do a $500,000 benefit, a $10K, and a 1.5 benefit. Let's check my oil on this real quick here. So I'm going to go up to 500,000. I'm going to do 1.5. It should be coming a little more than that. 44.13, right? No, 78.36. I'm real close there. I got 55 and 50. It's actually showing up a little bit less, but that's where I'm getting that premium from here. The 78.36. Okay, because again, I can't go any higher than 500,000. I'm trying to match the unlimited. I can only go to a 10K. Oh, a 10K. Yep. So let me do 10K here. All right. So I can only get up to as high as 500,000 10K benefit, and 1.5% inflation on this. So if I add this again to my second to die, getting that $166,000 second to die life benefit back, it's $1,245 for a married couple who's 55 and 50. So I add that together, I'm at $9,000 instead of $14,000, considerably less. How does it compare? Come claim time, okay? For $13,890, I have an unlimited benefit with One America that pays $12,139 in 30 years. Okay, remember I went a lot higher on my benefits because I use 1.5%. Okay, so and by the, I get unlimited benefit there, and so I get my death benefit. That one I would put an and there. So what's the drawback by doing it with an unlimited policy? Well, for about $5,000 less in premium, or that's about 40% less. Not quite half, but 40% less premium. I have a monthly benefit of $15,000, and I have a $1.5 million pot of money. Now I know that that's $781,000 each because I also put shared. That's what I did, shared care. That's what I'm missing. I shared this. I apologize, but I think if I put shared on. Okay, so the point I'm making here is that this come claim time for a lot less premium. So I went through this, and folks, listen, I'm going to wrap it up with this because there are a lot of ways to do this. I can compare these plans. I've done every one of them, every hybrid out there. And every time I do it, you're better off to break the long-term care and the life policies up. Don't sell a hybrid. What you're getting in a hybrid is you're essentially getting the overpriced long-term care portion. So look at this is One America. Look what you're getting for life and long-term care. Life premium here is $33.72. What was it for and that's for a second to die life that pays $166, actually for $120. Look at the long-term care plan. If I buy that separately, my premium is only, all right. So another way I can try to illustrate. See this second to die here for a 55 and 50-year-old to have $166,000. That's only $1,245 annually. If I look at the One America illustration here, okay, look what they're charging for that. Only $120,000 death benefit. $33.72. You're just basically getting you're getting charged triple for your life insurance to try to make sure they get their money back. It's just common sense here, folks. You wouldn't put these things together. You would separate them out. In this, okay, so how do you get there? So there's last thing I'll show you, by the way. If you don't want to have to go to a hybrid route, and a lot of people overlook this, in our software, for this 55 and 50-year-old couple, if I want to design a plan, I don't know, this $10,000 a month, look at, by the way, if I do this 3 times monthly benefit, let me explain how this works. So this person, they might pay $8,000 a year for 30 years. They're going to pay, I don't know, $200,000 in premium, $160,000 premium. If I put this 3 times monthly on there, they have to be over 65. Can't have it shared. All right. So without shared, without on there, 71. So for 7,100. If I put the 3 times monthly back, it only puts a $500 load on there. What does that mean? That means that this 3 times this monthly maximum benefit of $10,000. That means each one of them gets $30,000 at death. So that's $60,000 they get back, and look at what it cost them, next to nothing. So this policy was going to be $7,100 for a $500,000 pot of money and $10,000, monthly benefit. 3 times that is $30,000 each. I can get them $60,000 in premium back for $500. If I want to buy a hybrid to get them $60,000 back, it'll cost me $4,000 more, right? So I can show it you a number of ways, but that's a neat little thing to get like half their money. If you want half your money back, if you're worried about dying in your sleep and use it or lose it, tell you what, you can either buy a hybrid, or you can get half it back with this if you're not worried about it. So okay, after showing you all this, let me wrap with this because the second part I'm going to kind of show you how to get there. So there's no doubt about it in this day and age that there are 2 options. A very good agent of mine in Florida, again, the kind of premise behind the second part, he kind of mentioned again, Jeff, I can see that this is a better way to go about it. Separating a long-term care plan, a hybrid long-term care plan, life and long-term care mixed, I agree with you. You are better off to take a standalone life plan and a standalone long-term care plan and sell them as two separate products. Problem is when you're talking to a client is you've created the need, they know they need it, you went through what traditional long-term care is, then you go through what, how hybrids work. And I think in this day and age, I think it's disingenuous. I think you probably have to mention to a client, you can't just sell them traditional. And they're going to go talk to their brother-in-law who bought the hybrid. He's going to tell you, well, didn't you look at hybrids? Well, long-term care is not very smart. If you don't use that and die, you lose all your premiums, and they're not guaranteed. And so the guy ends up then canceling your long-term care. You didn't even bring it up to him, so he's lost faith in you. So I think as an agent in this day and age, you really have to explain how both work. I have to tell him this is traditional, and for a lot more money, this is how hybrids work. If the person is telling me, hey, you know what? I do want a hybrid. I see what you're saying there, but I really do worry about that. I think I'm leaning more hybrid. If that's the case, then I'm not going to sell them the hybrid per se. I'm going to say, let me show you how you sell a hybrid. Then I show them the two different applications. I show them the two. So this is what hybrids work with. Take any one of my slides. I don't know, take this one. Do you want to spend 19 grand or do you want to spend 12 grand to accomplish the same thing? Right? I have examples of every single carrier that does the hybrid, not every single one. Most of the carriers that do hybrids, you can blow the doors off of them. I don't care which one you're using or how you're doing it. Again, beating a dead dog here. Selling a hybrid is never going to be better than selling a traditional long-term care and a separate standalone life policy. So to get in there, when you walk them through, you explain how both work at the end, and you tell them, look, which one are you leaning? Because if you're leaning hybrid, let me show you a smarter way to do that. And that's part 2. So join me on Thursday. I'm going to take that concept and I'm going to show you how to sell it, how to actually go through and tell people how to do that. So, and that's kind of like the premise today. So that I think on this screen, even, and we're going to send you a copy of this. You can click on this link right here to get registered. But we're going to tell you kind of how to, here's how the two work. Okay, you want hybrid? Well, let's look at a better hybrid. So this is called your special hybrid. All right. And I'll use Columbus Life just to kind of, if you're not contracted, if you're someone who can get contracted with life, if you have your own life products, we can, help you do those. If you're one of our big accounts that maybe has their life through another avenue. If we don't have your life business, we'd like to have it. Presenter, please provide me with your contact information. My name is Jeff Clark. I've been with GoldenCare for, I guess I didn't do an introduction. Jeff Clark, Regional Director, GoldenCare USA, 800-842-7799. That is a number you see on your screen, by the way. Otherwise, you can email marketing@goldencareusa.com. Someone else is asking me, when I'm in a situation where I need advice, yes, I am available for advice. If you are talking a hybrid with someone, you want to give me a call. Another question about transferring assets. Yeah, those are sometimes you would use them. So you do get both benefits versus either or. So I have someone kind of telling me that in some of these plans, even if you use up your long-term care benefit, they're still going to give you a death benefit. I know that's the case in MedAmerica's Unlimited. There are some of those I looked at that you didn't get both of them. If you use it the long-term care portion, you didn't get the life. But Jeff, if you could point me out which one those are, I would love to correct that. If anyone else saw something that I'm flawed on here, believe me, I would love to snuff that out. Because even if you don't get both benefits, or if you're getting both of them, you're still killing them in premium. You're destroying them in premium. The premiums I'm doing here, another question, how are you assuming how much is paid? Well, I'm doing till claim time, because once claims, you don't pay your premiums anymore. So a lot of these assumptions, I'm using average claims right now happen at 81. I used 83 to be a little more generous. So these are all premiums until you're 83, 84 years old. If you're worried about paying premiums longer, again, you can always put more in the life there. Just using all averages. You're showing high monthly benefits. In actuality, what was the average monthly benefit for the average? I know people, averages are tough to say. Parts of the country it's more expensive. I think if you're selling long-term care in this day and age, we can't sell the whole amount. I personally like using a higher monthly amount with a lower inflation, because if the companies they've increased rates, all companies now, I'm talking about long-term care carriers, they've really attacked the 3% and 5% compound inflation rate. That's where they really hit you with the rate increases. If you want to get around that, you want to get your client more bang for the buck without killing them in premium, increase your monthly amount and lower your inflation amount. The crossover I know happens out down 20, 30 years. You can argue this, but generally speaking, I like a shorter, fatter policy with lower inflation. because again, at $4,000 a month, I see people selling $4,000 and $5,000 a month a lot. These nursing homes are $7,000, $8,000, $9,000 a month. And I know you don't need all your income, you don't need to do the whole thing, but I'd rather have a policy that has some, with 90% of claims not going beyond the third year, then you really want a short, fat policy, paying everything they can up front. Most of these other questions are very similar to that. Underwriting differences, I think, again, both policies are going to be underwritten. So they're wondering if one's a little bit easier. I haven't found that the long-term care hybrid plans are that much easier. If you're diabetic or you've got some issues, you're just not going to get either one. But that's a question where if you have a case, I would suggest you bring it to our marketing office. We'll call the different underwriting offices and try to help guide you there. Okay. Actually, his comment came before. Okay, that's an either or. So someone else was kind of agreeing that you get either or benefit. You don't actually get both benefits. So thanks for clearing that up too. Folks, that's about it here. I'm going to let this wrap up. I'm hoping the next part here, I'm going to try to show you just some ways of transitioning. Now, having shown the long-term care presentation, having shown people that there's a better solution than a pure hybrid, let me show you how to get there. And I should be honest with you, I haven't really designed a lot of it yet. I've had a lot of ideas on paper, so we're going to try to get something put together for you on Thursday at 11 a.m. Central. So thanks a lot for coming on board. I'm going to sign off, and any questions, call us at 800-842-7799. Thanks a lot. Bye-bye.
Check out our website, goldencareagent.com, or give us a call at 800-842-7799.